Good evening, all. This is Shay Horowitz, ShogunTrading.com. This is our free weekly newsletter. The market, this is something I've never seen before. I don't think anybody's ever seen this before. It's unprecedented. It's exciting. It's different. Rules of the game are changing for at least for a little while, at least on a temporary basis. I've never seen the government step in and make a trade like this. And what they did is make a trade. And let me explain you what I mean by that. The government took a serious position in the financial markets last week. They bought a lot of shares of a lot of companies that fell apart, and the bottom, exactly at the bottom. If you look at actually when they acquired AIG, for example, they acquired them near the bottom, and then they changed the rules, and they said, you know what? You can't short financial stocks anymore, and then you have a Reg T on shorts, and then no more naked shorts, and so many different rules that they change all of a sudden in the middle of the game, which must be nice. You know, you are able to buy something, buy a company, and then you change the rules. Frankly, I think with all this bailout and everything, that there's a potential for the taxpayer to make quite a bit of money over here, which is very interesting. And why? Because the taxpayer or the government or whatever you want to call them are able to make up their own rules, break the rules, no problem. That makes for a very volatile market. I don't like to see government stepping in and saving the market, because I think the market should be free. I do think that government should be saving people. I think that people should be saved from fraud. And I think if there was a lack of oversight, and I think if people were defrauded, I think that the government needs to correct that. And I hope that's what they're doing right now. They are in the midst of approving a $700 billion bailout, basically buying all the bad mortgages. Frankly, about time, and the reason why is because if we would have done that a long time ago, it would have been, first of all, a lot cheaper. Second of all, it would have averted this financial crisis, and we wouldn't have to bail out Wall Street as much as we have to. This is something that people that I've been talking to and myself have been calling for a very long time, is for them to actually take care of the root of the problem and not keep fixing holes in the bucket. You know, just take care of the bucket. Don't fix holes in it. Don't patch holes. And I hope that's what they're doing right now. Now, I'm not a political commentator. I'm a trader, and that's what we're going to focus on right now. The S&P 500, this is a chart, S&P 500 on an hourly basis from last week, and last few weeks have been really dangerous for trading, and the reason why is because of all this volatility. This is a normal bar. You can see normal action and how small normal action is. Very, very well organized, no problem. Great, not a whole lot of noise, and all of a sudden you can see noise. That's what we look at in trading, even in day trading. This is what you look at. Why? Because risk is defined as the likelihood of you losing money. You can be completely right about the trade in day trading or in swing trading or whatever you're trading. You can be completely right about the trade, but if you're using stops, if you're using stop losses, then noise can knock you out. Noise is the size of these bars. Is how much pain do you have to endure in order to find that your trade is correct. For example, let's say that you're trading breakdowns, and you're looking at a breakdown of this level, and you say, you know, great, this was level 1218 and we broke it. How much of a pullback do you have to endure before you find out that you were right all along? The more noise, the more of this pain you have to endure. Even more, if you enter inside of a bar, you have the whole, let's say you enter inside of a bar, you have the whole bar itself to find out if you're right or you're wrong, if the market is with you, if the market is going against you. And that is risky. That is risk by itself. If you look over here, for example, you can see that it's nice and smooth. No problem at all. There's not a whole lot of noise. So the noise level last week was absolutely horrendous. Let me put it on a daily basis. And let me put it on candlesticks. just so you can see the size of these candles. These candles are humongous. That's the range for the day. Lots and lots of noise, lots and lots of movements without really going anywhere. Even more risky than that was the type of gaps that we had. This is Morgan Stanley, for example, and you can see that if you were short Morgan Stanley, you were doing pretty well. Gap down, gap down, gap down. All of a sudden, calm down, and all of a sudden, a humongous gap up, and that gap up was a 30% gap, and 30%. I'm sorry, that was not Morgan Stanley, but Goldman Sachs was quite a bit. I forget if it was 30%, but it was quite a bit of money overnight, just because they changed the rules. Let me go back to bars, and you can see how these stocks are trading. And even bar, gap down, close down, gap down, close up, gap down, all the way down, close down, gap down, all the way down, all the way back up, huge gap up, close down from the gap. This is an unbelievable amount of noise that you can decide that you want to go short, and you go short over here, the stock goes all the way over here, you're out, but you were totally right about the trade. That's the problem with trading noise. Now, what did we do last week? What we did last week is basically stay out. We stayed mostly out last week because I decided that the noise level was just way too high. Here's a perfect example. You can see the last trend, and we really enjoyed this trend. This trend was great, no problem. But look at this one. You can see the noise. Okay, I think I talked enough about noise. Let me talk about different sectors and what they look like. I'm going to go back to hourly charts. I'm going to go to XLF. XLF is the financial sector that everybody's talking about. And you can see that this one is a complete mess. And this one includes the Wall Street and so on. But I don't think this one looks quite as good as the regional banking. Regional banking is wants to basically exclude Wall Street. And it's a little bit more specialized. And you can see the type of consolidation and the breakout we're having right now, which is great. Let me show you another version of this. Whoops. Look at KRE. You can see basically the same thing. So when you're picking what kind of trades you're going to do, make sure that you're picking the right sector and not just generic. There are sectors and there's some subsectors as well. And right now, I think that the regional banks are much better shape than Wall Street, of course. Our trade that we've done really well with is ARTC. ARTC is a stock that we bought on a breakout, and it ran all the way up to the $35 level from 27 for us. And we actually entered on the long side while the market was taking a dive, because to me that was a safer bet, a safer trade, because the market on the short side was so volatile, and I did not want to get into the financials because I thought there was way too much risk over there. Anyway, not every trade, not every trend in the market is tradable. Not every move in the market is tradable. Not every move in the market is safe. You have to be picky, and you have to look at your risk versus reward. Risk, as I said before, is noise. Reward can be great, but if you get stopped out 20 times on the way to capture your profit, you didn't do anything. So always risk versus reward, and that's what we do over here. I'm not sure what's going to happen now. We have to see what the bailout is going to come with, and I'm going to take this week to analyze the market and see where we're going to go from here. Anyway, have a great week. Stay safe. Watch the news and look for the best trades. Take care.